Well, my bit of this is to talk about federal tax legislation. What is pending? We all know that the House has left the Affordable Care Act and moved towards the federal tax legislation issue. And so we're going to chat about what is in the wind for what we're labeling Trumponomics. So probable 2017 tax legislation. You heard Rob mention the process being in question. And it really is in question because the Republicans are uncertain as to which direction they're going. As you mentioned, in the Senate, they do need 60 votes to do permanent legislation, and that's because of the filibuster rule. You've seen the filibuster rule busted twice. The Democrats broke it about 5 years ago when they needed to appoint some judges for appeals against the Affordable Care Act. The Republicans followed that, busting the filibuster rule around the recent Supreme Court approach. But it still stands for budgetary legislation. So to affect the budget on a permanent basis, you need 60 votes in the Senate. And obviously with 52 votes, no lock on the part of the Republicans in moving forward with federal legislation. So if they feel that they can find 8 Democratic senators to join the party on tax legislation, then we will get permanent legislation. If they don't find that Democratic support, then we will see the filibuster rule broken, or actually you don't break the filibuster rule. You can do one budgetary piece of legislation per year on a simple plurality. And so that would be done on a simple plurality. They would have the 52 Republican votes, but it would be a 10-year budget act and not permanent legislation. That's been done before. Back in the Bush era, there was a repeal of the federal estate tax. You might remember that was a 10-year process. The estate tax sunset in 2011. I think it was Steinbrenner had the wisdom to die in the right year. And then we went back into the federal estate tax. So this process has happened in the past. It's going to be interesting to see how that plays out because that is a big deal. The more complicated the tax legislation, the less likelihood of getting the two-party support for it. Now, you might say, well, this is all coming up pretty quick. Federal tax bills are very complicated. But this has been going on for a while. The House back in 2016, against all logical prospects, was working on a tax bill. Remember, a Republican House facing headwinds and the likelihood of a Democratic president. And yet they were working on a tax bill with some significant effort in that process. They put together a blueprint. It's about a 40-page document that laid out their vision of how reform should occur with the individual system, the corporate system, and so on. That is really the blueprint for what's happening. You might have seen the news comments about Trump's proposal and how it was literally a one-page document. If you look at that document, it almost entirely follows this House blueprint. So that's really the more fleshed out sense of where we're heading here. Now, some of the pieces of this. Trying to spur economic growth, of course, the concept is we lower business tax rates, businesses have more capital, they then can invest, they can then employ, and all of those actions that spur an economy. But businesses today are not just C corporations. That's a relatively small piece of the equation. C corporations today are about 2.5 million tax filers. Pass-throughs, small businesses, S corporations, partnerships, and proprietorships are 30 million. The money isn't with the C Corps anymore. That's only 11% of federal revenue. The money is with individual taxation because businesses are organized as pass-throughs. They don't pay tax directly. The income flows up to the 1040s of the owners. The owners pay the tax. So to drop the corporate rate just touches the tip of the iceberg. Like I said, 11% of the budget. So the concept in both the House and in Trump's proposal is to lower business income. Make that akin to capital gains, where if it's business income, we set it to the side, tax it at a lower rate. So it doesn't matter how the business is organized. And then there isn't the gamesmanship about how we structure. But that has a lot of problems. And I'm going to park that idea. I'll show you in a slide in a moment and illustrate why that's so problematical. Talking about other areas of possible change, repeal of the estate tax. That's always been a big deal on the Republican side, especially the very conservative side. But Trump's proposal is to come back and at death of a larger net worth individual to tax unappreciated capital gains. Now that's essentially calling it a different name. It's essentially a tax triggered by death on a high net worth individual, just label it differently. You might be able to stand before your electorate and say we've repealed the estate tax, but substantively a lot of it is similar. That's going to be very contentious. One side of the equation says the federal estate tax is minuscule in terms of the revenue it produces. Produces about 0.6% of the federal budget. A very small number. And the supporting argument with that is lots of time and effort, lots of labor, lots of very smart people trying to work around that tax. A lot of wasted allocations. The other side of it is this country has historically always believed in redistribution. And that means that the very wealthy at a death event ought to be paying in some to the system. Simplification is a big piece of this legislation. That hasn't been much covered in the press. Internal Revenue Code has gone from around 20-some thousand pages, the code and regulations, to about 70,000 in a 20-year period. The complexity of our system, as someone who works it heavily, deals with the IRS heavily, it is out of control. Our software vendors cannot keep up. The IRS cannot keep up. Complexity is out of control in our tax system. It needs cleaning up. A simple illustration of that is the higher education benefits. Some of you are involved in educational process, or many of us are parents where we're educating kids. There are 3 different alternatives for how you are rewarded for your college education tuition, but you can only pick one of the 3. All 3 have different income phase-outs, different magnitudes to them. It makes 0 sense. We've got something like 11 or 12 different incentives around higher education costs. So the history is, of course, of Congress just piling on. And what that leads is to confusion on the part of taxpayers, complexity on the part of preparers, and something that doesn't make any sense overall. It needs housekeeping, and that's a big part of the process that we're talking about. Now, we talked about how business income supposedly to be set aside, taxed at a lower rate. Why is that so problematical? Let's take a quick illustration. We said that small businesses almost universally are organized as pass-throughs, and that's where the jobs are in this country. Not with the Fortune 500, there were small businesses. We've all seen the statistics on that. So there's some small business making $200,000, but the owner works in the business and should be compensated for his or her labor. So let's assume that $70,000 is the wage that should be paid reasonably to that owner for their full-time services in that business. That's an expense of the business, so now we have income of $130,000. The $70,000 flows up to that owner as wages for their labor and is taxed as wages. And the rest of the income flows through. So no matter where we put that wage number, there's going to be $200,000 in that 1040. Today there's a lot of tension around that because the wage number costs that individual Social Security tax. There's 15.3% Social Security tax paid on that wage. So take your time. This is what we call a rhetorical question. If you're that business owner, do you want your W-2 to be smaller or larger? Like I said, it's a rhetorical question. If you can push down the W-2, you've just shaved off a 15.3% Social Security tax. And the business owners have long ago figured out that paying more into Social Security is not efficient. Social Security is a massive redistribution system. If I could set my salary anywhere I wanted and still satisfy my wife's need for income, which is an impossibility, I would set my salary around $50,000 or $60,000 a year. Because in today's system, if you make more than that, your feed into Social Security is being redistributed. It isn't assisting your retirement benefits. So Social Security, massive redistribution system, and there's a natural tendency to try to compress the numbers. IRS has a very difficult time dealing with that tension in the system today. And now, if we are to say that business income is going to be taxed at a special rate, whereas wages and other income are going to be taxed at a higher rate, you can see how much more difficulty there is to this question. That W-2 is just regular old income. That would be taxed potentially, we'll say, at 35%, whereas under Trump's proposal, business income set aside taxed at 15%, you can again imagine the tension. So how Congress is going to draft this and make that work and have an IRS enforce that is going to be a huge challenge, and that could cause that concept to crumble, even though if you look at it from an economic standpoint, you would say, yes, it makes sense to incent business income where we want to spur some job growth and some investment growth. Let's talk a little bit more about the individual system. Today we have a 7-tiered system, goes up to 39.6%. The proposal in the House plan was to cap the top rate at 33%. They talked about a 3-tiered system capping out at 33. Trump proposal is 35. That number is highly movable. As this legislation moves forward, That's the type of thing that'll move up and down through budget negotiations and through negotiations between the two parties. It is not, however, just a cut in the rates. It is also a significant elimination of deductions. It is possible that this tax bill, even with that kind of a cut in the top rates, could come out revenue neutral. How do we do that? Very simple. We just take away deductions. Now, if you've dealt into Schedule A in your 1040 and looked at the possible array of deductions there, you know it's more than just a few charitable contributions and a few tax deductions. There's all kinds of expenses built into the 1040 itemized deductions that are quite complex. The proposal is to double the standard deduction, so the removing at the lower tier is not so painful. Standard deduction today is roughly $6,000 for an individual, $12,000 for a couple. They're proposing to double that. And then in both the House and the Trump plan, only two itemized deductions would remain on Schedule A. Charitable contributions, very important, of course, to many of your organizations, and home mortgage interest, where this country has had the mindset that the home mortgage interest spurs home ownership, and that's considered a good thing for the economy. There hasn't been any direct indication about the second home rule, but reading the flavor of the document, reading that Better Way plan that the House put together, I am betting, and this is one person's editorial, I am betting that we're going to see, if this comes to pass, a house mortgage interest that is principal residence only and not that second home. So all of you cabin owners who every week head to northern Minnesota and enjoy the deduction for the interest expense on your cabin, that is likely to be a deduction that goes by the wayside. Except the House proposal says we will not upset existing mortgages. We will not upset existing mortgages. They will be grandfathered. What goes away that's significant is state income tax and real estate taxes. State income taxes, I think, are in trouble. Guess which states are the high taxing states? Red or blue? Again, another rhetorical question. It's the Californias, Minnesotas, New Yorks, Massachusetts, and so on that are high taxing states, as opposed to many other states that don't levy an income tax at all. And that disparity, that federal subsidy to those states, is something that's likely to go by the wayside. Some of the ACA taxes, if they don't go with other legislation, are also part of the proposal to repeal. Capital gains, not a big change. They're going back to an older system where we would take a capital gain, remove half the gain from the tax return, and then apply the normal rates. Today we take capital gains aside and apply special rates. Those rates basically 15 and 20%. This would take it aside, throw half the gain out the window, and then apply the ordinary rates. Isn't going to change things dramatically. It would lower the top capital gain rate a couple points. The biggest piece of this legislation, and I think you'll hear a little bit more about that later, is the approach to the corporate system and the global tax system. And probably the easiest way to explain that is to compare the US system to the developed countries, the OECD or the top 35 developed democratic economies. This is essentially Europe, Australia, countries like that, the Chiles and so on, who average, as you can see, about a 24-25% corporate rate. We are at 35%. We are up there with two other countries in terms of our corporate rate. That economic powerhouse of Chad and, and the United Arab Emirates, which live off of oil. So we are off the charts high in terms of our rate. And we have a territorial rate system, which means that if you are a US company and you earn it overseas and pay the German tax, the French tax, whatever it happens to be, and then bring the capital back to the US, you are subjected to the US tax system, a second tax. Now you'll get a credit for what you paid to Germany for their 15 or 20%, but you pay the extra up to 35. So why did we see Medtronic leave and become Covidien in Ireland? Because if they remain a US company, and virtually all of the Fortune 500, of course, are global. They're hugely global. Most of their money is earned overseas. But if they're in the US and they bring some of that capital back to deploy it here, they pay the 35% rate. So we are handicapping investment in this country by that difference, 10, 15, 20%, which means they don't bring it back. So we've seen the statistics. There's support on changing this on both parties. Both parties have recognized the economic drag we've put on our global companies and why they're leaving. So I think we're going to see that part of it. We could get a tax bill that really just addresses that piece. That would be relatively easy to pass because, again, there's bipartisan support for it. It is also, however, going to pay for some of the other things because of the concept of a repatriation rate. The estimates of the dollars sitting overseas with the U.S. companies is in the trillions. And so the idea is, let's have a tax holiday, invite some of that capital to be invested back in the U.S., charge them a 10% differential, which would be a bargain, and see if we can't get that money back in the U.S., creating more jobs, more factories, more investment. So that would pay for some of the other changes. Many of the other items I won't get into, they're a bit technical, but same concept, lower rates, but eliminate a lot of deductions and a lot of complexities. The border adjustment thing is very complex. That's a fairly conservative Republican position that I think is not going to go anywhere. The idea that those who import would be taxed, but those who export would not be taxed is hugely problematical in terms of creating winners and losers. Few little thoughts. There is going to be, if this tax bill comes to pass, a drop in rates. And that means deductions ahead of this tax bill are more valuable than deductions after the tax bill. So when is this going to happen? Is it going to happen in the 17 tax year retroactively, or is it going to happen out in 18? Whenever it happens, again, the concept is deductions are worth more in a higher rate system than in a lower rate system. So that means things like funding retirement plans in a higher rate system, going extra in a 401k, for example, would make a lot of sense. Or buying that lake cabin, if you're in the mindset of doing that, and locking in a mortgage ahead of time. Those are the types of things that tax advisors are going to be thinking about as we see this legislation going forward. This is something that hasn't really hit the press. There is significant effort going on in Congress, and has been going on for the last month or two, around tax reform. But you don't read about it because it's not high profile. It is various committees in Congress, Transportation Committee, Ag Committee, holding tax hearings, hearing from constituents, individuals, businesses, lobbying groups about some of these tax proposals and how might they react. For example, House Ag Committee over a month ago held hearings. One of our partners, Chris Hesse, a very learned tax individual, heavily entrenched in the agricultural industry, gets invited to Washington to testify. So Chris is before the Ag Committee, and all kinds of back and forth about how we reshape, how we simplify, and where does it make sense to make these types of changes. So this is a bigger deal than what we're seeing in the press. There's a lot of underlying action going on around this legislation. So significant changes akin to what we saw in 1986. I'm old enough to remember the '86 Tax Act. In fact, I was involved in some testimony in Congress back in those days. That tax bill was systemic. And this is the type of thing we're talking about today, if it all comes together.